Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for April 27th, 2013. We have a market that is still in bullish volatile conditions. On an annual basis, using weekly RSI 14, we're at the high end of neutral at 68 out of 100. 10-day NDX, the short term, we're at 82 out of 100, so we're in overbought conditions. Percent stretch relative to the 200-day moving average is green bullish at 9.30%. Slope of the 50 improved, but is still yellow neutral at 0.44. The ADX is very weak and non-trending at 14.4. The ATR percentage at 1.13 is what puts us up into volatile. Using the risk index as the 30-period moving average of the VIX divided by the 10-period, we're at 0.94 for a risk-off condition, although that is tipping over into risk-on, as you can see on the time series here. The z-score of that reading of 0.94 comes in at minus 0.77, and we've just tipped upwards after coming down to a 1.0 z-score, and in the past that has been an indication of a shift in volatility away from volatility and back towards quiet and bullish conditions, so we'll be prepared for that shift in volatility. The blended monthly rebalancing, no changes on these, still holding in the 26, the MDY, Japan, and financials, in the 13 ETF holding mid caps, Japan, and US small caps, with the next reevaluation due on or about 1 May. In the weekly ETF2 model, the theoretical exposure is at 80%, the model portfolio is at 100% exposed, and all we've got to do this week is update some stops as we've made some new highs in many of the holdings. In the Trade of the Week series at the YouTube channel, there are a number of very important discussions for shorter-term traders on some of the recent videos that are worth your attention. Looking at the blended monthlies portfolios just for current strength, right now the leaders are Japan, U.S. real estate, and Australia in the 13 ETF. And in the 26 ETF, it's Japan, financials, real estate, and Australia. Next up is the market health check. Oh, I like that better, larger. Let's try this. And so what we have are the vertical blue lines at 10, 20, and 30 days of look back. The blue shaded region in the middle is the 30-period Bollinger Band plus or minus 1, the river. The lighter blue is the floodplain at plus or minus 2 standard deviations. The black line is the 30-period regression line. The outer black lines are the regression channel formed by the maximum excursion during the look-back period. We have the slope of the 30-period regression line plotted here. It's just positive and started getting more positive. The shaded red area is the 200-period moving average in the region below. You can see ADX above, and then percent price oscillator here, which just opened its jaws to the upside, indicating a favorable long side orientation, and then percent R has gone from 10-day percent R has gone from oversold to overbought as part of this move right here. So this still looks like a bullish market that has found its support at the middle of the river and is now going to test the swing high at 160. The horizontal red lines are various support levels that have held in the past, and which become downside price targets if price fails here. And so this is still consistent with a bullish market, but one that is a little bit weaker than it was in this run-up. So if we count this from this gap up as one leg, two legs, and now potentially the start of a third leg, what we would expect to see there is a successful test to 160, and then smooth sailing ahead as there's no resistance overhead. But if it fails there, then we would be seeing price reverting back into the river and then testing these support levels here at 154 and 152 and a half. So still favorable conditions, good for swing trading, fully valued right now, and let's see if we can get through 160 here this week. ETF2 regional report. This looks at the 10 regions of the world market model. 2 of the 10 are on cash positions. That's why we're at 80% invested, 20% cash in the theoretical model. We're both volatile conditions. The SPY is better than the globals, represented by EFA. SPY coming in at 66 compared to 64 in the globals. Among the U.S. indexes, it's mid caps and small caps. Mid caps and large caps, followed by small and tech, still being weighed down by Apple. The 2 strongest sectors are Japan at 82, U.S. mid caps at 66. The 2 weakest are Latin America at 48 and emerging markets at 53 in terms of relative strength. Looking at the world market model through the same lens, we see all of the U.S. Above average, Latin American emerging markets below average, including all the individual countries. A mixed bag between Europe being above and below average, with Sweden still being, and Switzerland being the 2 strongest. Asia, less Japan above average, Japan dominating at 82. In the rest of the Asian countries, leaders are in green and white, including the younger ones here, Thailand, Philippines, Indonesia. Among the alternate asset classes, oil had a little resurgence, came out of the red into the yellow this week. Private equity remains strong. U.S. real estate and treasuries remain strong. Otherwise, very far under average for gold, silver, and commodities. In the business sectors, the defensive plays are still working: staples, utilities, healthcare, and with the U.S. Dominating all of the matchups in the global business sectors, with the exception of industrials. Top 30 ETFs based on the world market model and the ETF2 database, sorted by relative strength. Those that are in green in the relative strength column and white in the consistency column are ones that are adding to their strength, meaning that they are stronger now than they have been on average. This is a 10-week moving average of their strength column. So all these that are green followed by white are ones that are moving up in the stack. So things like solar, biotech, the MLP index, utilities, those are all getting stronger. Those that are green and green are ones that have been on the list for a while, and in some cases are starting to move down a little bit here, like Thailand. And that's how we read that. So little change week over week among the leaders. This is the Dow 30 based on the same lens. Again, the predominance of the Dow in the strength in the UX, making these green. Now these come from the same comparisons with the rest of the ETFs in that 1500 ETF database, so that we have a nice reference of what's actually working among the Dow 30. Hewlett Packard still in second position, Boeing in the top position, Alcoa and Caterpillar down at the bottom. Again, those that are in green in strength and white in consistency are those that are adding strength. So we're looking for continued leadership among Microsoft, Coca-Cola, DuPont, Walmart, Intel, and McDonald's. That would be where I'd be placing my money to take advantage. ETF liquidity stats. And now we'll shift over to the daily report. I've expanded the look at the risk Z-score out to the last 90 days, so you get a sense of this smooth oscillation here in the VIX. No signals in overreaction or channeling. We have some pattern traits among the Dow in channeling and overreaction. Triple screen in McDonald's, 551W patterns in United Health and Pfizer. And these in the auto framer are symbols that test up better than 2 to 1 on reward to risk ratio. Dow tactical summary, quite a few dojis, channeling and overreactions, and then some terrific auto framer risk to rewards among IBM, Cisco, United Health, United Tech, Procter & Gamble especially. And the ETFs, fewer test out well on the auto framer, but still some to choose among the inverse VIX. XIV ought to do well if the risk cycle of the VIX holds true over the next couple weeks. A handful of dojis to look at, Treasuries in the number 2 position for reward to risk ratio. You see in the market mosaic, the regression line has crossed over, 30-period regression line has crossed over its own 10-period moving average at the 6-month average and still above zero. So that points the way to the possibility for an extension of the bull market over the next week or so. And that would be a successful test to 160. Just some statistics now. I'll leave these up on the screen for a few seconds for you for the fail stat, signal to noise ratio. A new chart that I've added for you just to summarize the S&P's variability over different holding periods. And if you looked at the last 10 years and computed what percent the S&P had returned for holding over 40, 20, 10, 5, and 1 days, you would find these values here, that the maximum, for instance, over the last 10 years for holding 40 days was 33.93%. The worst 40-day performance was minus 37.53%. So you get a sense of just how variable the S&P can be over those different holding periods. This chart shows the relative variability of the z-score. So when you convert that 33.93 to a z-score, the z of the maximum was 4.79. And if you look at the 1-day biggest return, 14.51%, that computes out to a 10.78 standard deviation based on all the other holdings in 1 day. So you can see the range of percent variability on the right-hand chart, the range of standard deviation variability, and just gives you a sense of the real dimensions of swing trading. And I'll just flip through the remaining charts here. I would just point out that the slope of the z-scores at 30, the 30-period regression line is hooking up right at the mean, right where you would expect it to, on some strength over the last 5 days, which has moved the 10-period regression line slope up. The 90 is still exceptionally strong, so we're still in the middle of a really powerful 90-day move, and the 10 and the 30 are now starting to show some support here after a rebound. And that's why I still think there's room to get up above 160 here on this next test. We're out of the river, as you can see here, and the test of 160 would be the normal follow-through. And I'll just flip through the remainder of our charts for your reference. You can stop this at any time and check them out if you need to. So that's it for the weekend review. We'll be on the webinar tomorrow night after our soccer tournament. Let's go Leavenworth Thunder. Take good care. Keep your powder dry and your risk measured.